This is a video lecture for AccaBelfast financial reporting. We're going to be looking at leases and how they're accounted for under IAS 17. And we're going to be looking at it from the leasee's perspective. So under IAS 17, there's two different categories that a lease can fall into. You have your finance lease and your operating lease. And whenever you're in the exam, you need to try and determine from the information that you're given whether or not this contractual arrangement falls into the finance lease category or the operating lease category. And there's two different types of accounting treatments for these two different categories. So whenever you have a finance lease, all the risks and rewards are transferred to the leasee. So what do we really mean by this? Well, if you think about leasing a car, you have the rewards as the leasee, so you can use that car whenever you want. And you can go wherever you want. So those are the rewards that have been bestowed upon you. And whenever we're talking about the risks, if something happens to that car, then you're going to have to foot the bill. So that's really what we're meaning when the risks and rewards are transferred to the leasee. Now in the exam, you're probably going to get a scenario situation or some information that you need to determine and you need to use to determine whether or not it's a finance or an operating lease, and whether you're going to account for it as such. So this is a checklist that you should probably try and learn off by heart and take in with you to the exam, and just try and take the information that you're given and put it against these various different points. So the first one there's an option to buy. At the end of the lease term, quite often you'll find if it's a finance lease that there's going to be a nominal payment. And whenever you have paid this, after all the finance charges throughout the years or the months or whatever the lease term, then that asset legally becomes yours. The finance lease will also normally be the major part of the economic life. So at the end of the lease term, there's not really going to be much life left in this asset. So basically nobody else is going to really get much worth or much use out of it. That third point there, PV of MLP approx FB. I'm all about abbreviating things in the exams just to make a wee note to myself, so I'm not having to sit and write out, with big long sentences. I just want something to quickly refer to. So here I'm talking about the present value of the minimum lease payments is approximately the fair value of the asset. Now you can be given this in the question, or sometimes you may have to work out the present value of the minimum lease payments. But if the present value of the minimum lease payments is approximately the fair value, then this is a good indication that it is a finance lease and should be categorised as one. So specialise. Quite often in exams you'll see maybe a manufacturer or a manufacturing company, and they're requesting that an asset maybe be specifically designed or produced for them to lease. So really what we're thinking about here again is that nobody else really can use this asset. We had touched on that whenever we were talking about the major part of the economic life being taken up basically by this lease, and that no one's going to really be able to derive much benefit from the asset after the lease term. This again is sort of indicating that there's going to be nobody else deriving any benefit from this asset. And then the gains and losses, so this is basically again the risks have been transferred to the leasee. Substance over legal form. Legally somebody else owns this asset. But however, if it's a finance asset, you do need to bring it into your accounts and recognise it as an asset, and also record the liability that you're going to be paying out to this financing company. So this is really what we're meaning. Legally, you don't own the asset, but for financial purposes, we need to show this asset in our statement of financial position, because basically we're going to be able to generate income and have the benefits from this asset. So under a finance lease, you initially have to record the asset at the fair value or the present value of the minimum lease payments. So you record the asset, but then also record a corresponding liability in your statement of financial position. With a finance lease, because you've recorded this asset, you need to depreciate this asset, and that's either going to be over the shorter of the useful life of the asset or the lease term. So whichever of those two are shorter, this is what the depreciation is going to be calculated over. This is then just charged to the income statement as you normally would be doing with any other asset. So the payments, the finance charge, this is a hit to the income statement, but then again you also need to reduce your liability that's sitting in your statement of financial position. there's quite a few things really to be remembering whenever it's a finance lease. You need to record the asset and the liability in your statement of financial position. You need to charge depreciation, and then you also need to adjust for the finance charge both to the income statement and then to the liability that you've recognised in your statement of financial position. So an operating lease. Basically, this is the easy one. If it is an operating lease, you don't recognise the asset, you have no depreciation, and it's just basically a straight charge to the income statement. So you're hoping that in the exam this one comes up. However, because the examiner is testing your knowledge, obviously he's probably going to make it a bit more difficult and choose the finance lease category. So if it's incorrectly categorised, what's the big deal with this? Why is it such an issue? Well, as we saw with the finance lease, the asset and liability is recorded in financial statements, whereas an operating lease isn't recorded. So if you have an asset that maybe is generating a lot of income for you, or you're deriving benefits from it, then this has been left off your balance sheet if it's categorised as an operating lease. And this really would mean if it was incorrectly categorised, you'd have understated assets and understated liabilities, and this can affect things such as your gearing. So sometimes perhaps maybe if the gearing ratio needs to be a certain level in a company, people may try and classify a lease as operating rather than as finance. And this is something you need to bear in mind when you're reading the scenarios given to you within the exam. So just to summarise then, when thinking about leases, firstly the categories, finance or operating. Think of that checklist. If it's operating, then all we need to do is just think about the finance charge to the income statement. If it's finance, there's a number of different things we need to be looking at here. So you need to recognise the asset either at the fair value or the present value of the minimum lease payments, and you need to also recognise the corresponding liability in your statement of financial position. Depreciation must be charged, there must be a hit to the income statement for the finance charge, and also the liability needs to be reduced on a year-by-year basis for whatever way you're making those payments. Then also, just lastly, just think about if there is any reasons to misclassify. So, think about the ethical reasons of trying to classify it correctly, and whether or not it's going to be more relevant and improve the reliability and understandability of your accounts. So there's quite a number of things to be thinking about for these leases. Thanks very much for your attention, and I hope this has clarified leases a bit more for you.